Now, let's welcome our hosts, Jay Cherish and Dame Deity. This is Millennial Intent, Conversations That Matter.
Welcome to another episode of Millennial Intent, Conversations That Matter. Today we're going to dive into the conversation about life insurance, getting your family financially protected. There's a lot of questions that go into that. But as we stepped into the new year, we have witnessed heartbreaking events unfold around us. It is important that you utilize financial protection for your family. The importance of financial protection, life insurance, and financial literacy. Today, we are thrilled to introduce an incredible guest who embodies this mission. Miss Lillian White, the designated founder of Champion Nation, a leading financial service organization based in Florida, Georgia, and Texas. We welcome her. Welcome, Miss White. How are you? We're excited to have you.
I'm great. Thank you for having me.
Thank you. Well, we want to introduce you. So please introduce yourself and tell us a little bit about your journey.
Well, my name is Lillian White. Some people know me as Lillian Perry White. I've been with my organization for over 25 years. We help the community with financial literacy. I have one daughter, and I live in South Florida. Once again, I thank you for allowing us to come in and share with you.
Oh, thank you so much. So let's tell us, how did you get into the industry? And give us a little background about your industry.
Yes, I got into industry because of a family situation. My sister passed away at a young age, and she had two children, and we were affected by something that we weren't really familiar with, and that was life insurance. So that's how I got introduced to the industry, and the financial services industry is a constantly growing industry. So helping families to improve their finances and to become financially independent is something that I've always wanted to do. But, this industry helps me to be able to do that.
That's a good thing. So, can you give us a little idea of what life insurance and why is it important? What is life insurance?
Well, the term life insurance is basically a contract that pays money to the beneficiary after the death of an individual. We look at it as income protection, protecting your income, but life insurance is a contract between you and an insurance company that, in the event of a premature death, they would pay your beneficiaries the amount of insurance that you are contracted with.
Income protection. Could you explore that a little bit more?
Sure. Income protection, we look at as life insurance as a misnomer because it's really income protection. You're not protecting the life because there's no amount of money that can protect the life of an individual. I mean, I don't think there's a number for that. However, insurance can be bought to protect the income of that individual. For example, if you have a husband and wife, or two partners that are bringing in income, and one of the income is lost due to a premature death, then being able to cover that income that's coming in for as long as it's needed, maybe 5 years, 10 years, if you have young children, 15, 20, if you have a mortgage, 25 to 30 years. So you're actually protecting the income that's coming in, because if that income is lost, there's no way of replacing it except through life insurance.
Wow, that's an interesting way to see that.
Exactly. And life insurance can be like a maze, but at its core, it's designed to protect your loved ones, and the ones around you, that is something happens to them, You protect them financially, protect the ones around you. And it's curious. I know it's really curiosity how it works, but I want to get into the breakdown of why life insurance is so important for the family. So, can you tell us the importance of why families need to have life insurance to protect their family? Why is it important?
Oh, absolutely. Because life insurance is the only product that could actually create an immediate estate for that family. There's nothing else, unless the family has money accumulated that would actually um, take care of the expenses for that family until the youngest child is age of majority. Unless they have that amount of money set aside, then life insurance is needed for that reason, to make sure that that all expenses are taken care of, particularly the mortgage, the payments, debt payments, food, clothing, shelter, all of that being in place. So life insurance will actually provide for that. And that's why it's important to buy insurance on a needs basis, how much you're going to need in the event of that individual passing away prematurely.
I love that. And that kind of segues through my next question because when you think about peace of mind and financially protecting your family, people forget, you're going through a hard time, but you want to ensure that your loved ones are taken care of, even financially through their departure. So that goes right into the question, how much life insurance does one person or does a family need to be covered?
And Cherish, that is actually a great question. A lot of people don't know that. And in fact, a lot of times when people buy life insurance, they're buying it to basically put someone in the ground. That's basically what we say is, enough insurance to make sure that I'm put away nicely. But life insurance for most families, if you have a young child, and I'll just give you an example of, uh, the usual situation is when you have a young child age 0. So you would need your income set aside every month. So let's just say you made $3,000 a month. You would basically, of course, multiply that times 12 months in a year. That's 36,000. And then you would multiply that times the age of the child, the youngest child, to age of majority. So if that child is basically 0 years old, you look at a 20-year program or a 25-year program. So you would need that 36,000 for 20 years. So of course, you're talking about somewhere in the neighborhood of about $700,000 is a need for that's the need of insurance, total amount that family would need to protect their home and their family.
I love that. And I know that life insurance is not a one fit all situation. You have to go and deep dive into your personal finances, your personal situation to determine. And that's why it's been so important to meet someone like you to get an idea of what your family needs. I love that. So I'm going to shift a little bit. And Dame, if you have anything, I kind of want you to
Yes, my
chime
question is, I know that a lot of people, I know I was in a situation where people have like work insurance. I think people sometimes are confused. I'm going to use the term universal life insurance policy. But what I mean is a life insurance policy that covers if the events of everything happen to you
Right.
versus insurance policies that generally come from your job. I know this is probably a situation that most people are in, but could you kind of explain to us why it is important to have insurance outside of your job provider? Because
Absolutely.
there is a common trend among people saying, okay, well, I have insurance with my job. And then when they pass away, it isn't what they thought it was.
Absolutely. And that's a big issue. And the main reason why people purchase insurance that way is because it's cheap.
Mm-hmm, mm-hmm.
And it's understood,
Yeah.
you want to make sure that your family's protected. But let's just talk a little bit about group insurance. Group insurance is something that the corporation that you work for or the job that you work for offers. It's kind of like it is a benefit or an incentive for that individual to remain with that particular job. Group insurance is normally 1 times your salary. In some cases, depending on your level, twice your salary. However, group insurance is not owned by you, the individual. It's owned by the company that you work for. So in the event that the company has to cut costs, they could easily cut costs where, in basically places where it doesn't benefit them. Group insurance is one of those products that can easily be, they can no longer offer it based on budget cuts. So group insurance is great, but it's not something for you to rely on as far as your your overall financial plan. However, it is great to have. It's considered icing on the cake. I would say gravy on the mashed potatoes. If you have it, if it's offered to you, take it. But don't look at it as a permanent plan for you and your family when you're planning your finances. And the other thing is, many times when an individual leaves the job, and it's ironic because my husband, we talked about that a lot, and he said, I definitely don't want to depend on the insurance that I have on my job, because as soon as I leave the job, after 30 days, they're giving me an option to actually replace that insurance with an individual policy, but it's very, very expensive. So for a lot of people, they have group insurance and they're relying on just that insurance. And then when they leave the job after 30 days, they have to get insurance individually. And that's usually very costly. Plus, if you're relying on a group policy and your health changes, they're only going to offer you basically the conversion. So if the conversion is 10,000, that's the maximum that you're going to get. And if your health has changed and you're not insurable, that's the most that you're going to be able to get. So that's why it's important to have a policy and a good policy that covers all of your expenses, that, should your health change, you don't have to worry about fishing around for life insurance. Okay, so now to get to general insurance, for me, and I did talk about how much insurance that you're going to need, and it is important to cover your income, but you also have to take into consideration your home. If that house is going to be paid off, that's actually separate. If you have debt, that's important to think about when you're thinking about life insurance. So not only replacing your income, but also paying off the debts, paying off the car, paying off the home. If those are things that your family could probably not afford to keep, then you may want to look at taking care of that. So in general, life insurance outside of the job is what we talk about. Insurance outside of your job is crucial because so many things can change so quickly. And you don't have control over that, but you do have control over having your own life insurance policy.
Now, I know another popular thing people talk about is like accidental death. That's another popular one that's at a lot of jobs. Can you just give us a little small snippet on the limitations with that one?
Right. Now, accidental death is not normally sold as a benefit to an individual, to an employee. However, they tend to have companies that will come in and offer an insurance in addition to the group insurance that will cover by accident, but that's sold within a company and without. That's an individual package that will cover if you die by accident, if you get your arm cut off, your hand, your foot, that they will cover
So
that.
extreme. So
Yeah,
extreme.
well, yeah, I know, right? And the issue is with accidental death is that you have to read the policy, and we try to make our clients aware of that, because I've seen cases where a client will say, "Well, I have $1 million worth of life insurance," and I go, "Great, okay, what kind of insurance is that?" And they'll say, "Yeah, straight life insurance," and I go, "Are you sure?" It costs nothing to review your policy, only to find out that the $1 million of the insurance is actually accidental death. In other words, you have to die by accident. And
Yeah.
even even if you are in an accident, if you don't die by the accident and you die outside of the accident, maybe you had a heart attack like a month later or 3 months later, they may not pay because there are, stipulations to dying by accident. Plus, if you don't die within a certain frame of time, say 90 days,
You got to
then
die right. You got to die
right,
right.
they may not pay the policy. So accidental death is one of those policies that, I mean, it's okay to have, but that's still not the foundation policy that you want to have for your family, because if you don't die by accident, you die by an illness, guess what, how much they're paying? Nothing.
Exactly. Zero.
Exactly. And I think that shifts us into the conversation about, whole life versus term. I know there's a difference, but most of the people say, I want whole life. It's 100 years and not. Can you give us just a little synopsis on the difference between whole life and term? I know it's a big topic, but
Yeah, it is. And it really is. And so the best way that I can explain the difference between whole life and term is that the industry considers whole life as permanent insurance and term insurance as temporary insurance. Whole life is considered to be part of the cash value category, in that it has a savings, and term insurance does not have a savings. So that's basically the generic or the general terms of whole life and term. Now, when it comes to which one is better for your family, consumers say that 90% of the families would be better off with term insurance because it gives you more insurance coverage for your dollar. And that's basically what most families are looking for, that if they die, how much would be paid out. Whole life insurance is usually 6 times the cost of term life insurance for the same amount of coverage. And term insurance, although whole life insurance is purchased to age 100, term life insurance can be bought in increments of 10 years, 15 years, 20 years, and 25 years, all the way up to 35-year level term programs.
and
I want to touch on, I'm sorry, I just want to touch on something she said. When you use the word savings, a lot of people are misconstrued about what that actually means, because people think that they can, just go in and take money out of their whole life insurance. Just a brief synapse on the fact that, there are time stipulations, I believe, and that sometimes it isn't exactly what it appears to be as far as savings aspect, air quotes.
Absolutely, and the air quotes are right. So savings. It's interesting that when they do say savings, that if you were to compare that to an actual savings, it's actually totally different. It's not the savings that you're thinking of. One, because when we consider the time that it takes the money to accumulate, the money doesn't accumulate right away. Usually there is a 2-year, 3-year period of time before the money even begins to accumulate. And if you were doing business with a bank and you had a savings, you would be highly suspicious if after 2 years, saving money, that there's no money in that particular savings account because the bank said it that way. So you would probably not do business with that bank. And when it comes to savings, and pretty much your cash value policy has the same connotation. So as far as savings is concerned, the interest rate is usually very low as far as savings is concerned. And then the key thing to it is that you have to borrow this money. You don't have access to this money as you think you do, because you would either have to forfeit the policy to get the savings, or you would have to do something called borrowing or getting a loan, taking a loan out on the savings, which means you have to pay it back, and you have to pay it back with interest. And usually the interest is a lot more than what you're earning on that savings account. So basically it now becomes a product that the company's offering as opposed to an actual savings. Because, at the bank, you don't have to fill out a loan application to pull your money out of the bank. You just take it out, right? And if you do take out the savings and you don't pay it back, it is subtracted from the amount of insurance that you have. So you basically are
Wow.
paying for two things, but you only get one. You're paying for life insurance and savings, but you can only exercise one at a time. You can't exercise both.
Wow. That's a lot. Wow.
It is. It really is.
And I think a lot of people think about, well, I'm building cash, I'm building wealth, and they
Mhm.
don't realize it's either one or the other. And I know we're talking terms because we had this conversation personally about face amounts and understanding the difference in age 100. But I think that just for our listeners, can you give us the brief misconceptions of term insurance? Like, why do people not invest more in term? Because basically, a whole life policy. We'll let you discuss that. Give us some.
Of course, of course. Because when insurance is sold, it's normally sold in the form of cash value life insurance, whole life, universal life, interest sensitive, flexible premium, adjustable life, all of those type of insurances that embody a savings account. Term insurance, however, has no savings. So you're not dealing with a policy that costs a lot because you have a lot of fees that are part of the policy, or you have to borrow your money and pay it back. So you have just the actual pure form of insurance, which is term insurance. So most people, when they look at term insurance, the question they have in their head is, well, I don't have a savings. Well, I always say, well, where'd you get that from? Well, when I had insurance before, I had a whole life policy. And I always remind them that that's because that's what you were sold. So for most people, when they look at whole life insurance, they're sold a life insurance policy, normally term, actually term. And the difference is usually a savings that the insurance company created. But the original form of insurance has always been term insurance. So when I begin to educate, and I think it has a lot to do with education, that's all it is understanding what term insurance represents. It represents what you would need to cover and pay off and make sure that there's adequate money in the event of a premature death. So term insurance does just that. It protects you for a period of time that you need the insurance the most and the maximum amount of insurance that you need. So for most people, I ask them, why did you buy your cash value insurance? I bought it for the savings. Well, could you have been better off just taking that savings and putting it underneath your mattress? Or in a savings account at a bank, or in a money market account, or in a municipal bond account? Because if you do the numbers, and if you do the math, rather, the math, as my niece said, the math is not mathing, right? Because when you start to add up, right, you start to add up the numbers. Even if you put it in your couch, after a year, you'll have whatever amount it is, say $25 a month. If you put $25 a month in a cash value policy, after a year, you don't see anything in that cash value. But if you put it underneath your mattress, you can pull up your mattress in 12 months and at least you'll see $300. And that's without interest, right? And if you continue to do that, you will accumulate money. So the idea of the savings, the way to get wealth. And I think this is an important topic too, because a lot of people are getting involved with these IULs and they're getting involved with these programs that say that it can make you wealthy. Well, with most of these programs, you pretty much already have to be wealthy, right? And then you just come in, you're just dropping money into an insurance policy. And then when you drop the money in there, of course, there are fees to keep that money going. And there's a life insurance policy added to it. So if you put in $1 million and you change your mind after a year or two, you're not going to get back $1 million. You're going to get back the amount of money after the fees, after whatever the insurance company decides to keep and to hold on to, right? So for a lot of people, I mean, do you call that a savings? Not really, because you could have easily have taken that $1 million and put it into a conservative account and at least earned 1%, which is $10,000, which is nothing, but it's a whole lot better than having fees subtracted from your money and not have gained within that year. So I have to argue that whether or not that actual savings is actually going to make you wealthy. And then one last thing that I did want to say and about this topic. A lot of people get the impression that a savings when you buy an insurance company is what the face value is. If you buy $100,000 worth of life insurance as a whole life product, or even as a term product, you do not have access to $100,000 that you can take out as a savings. You only have what you put in. And it is delayed in most cases with the cash value policy. It is delayed for 2 years. So if in 2 years you've accumulated $1,000 and you have a $100,000 policy, you can only take out $1,000 and you have to borrow that and pay it back with interest. So for some people that get these policies thinking that I now have access to $100,000, now I can go out and buy a $100,000 home. No. First of all, that's not your money. It's your beneficiary's money. That 100,000 is for your beneficiaries, not for you. You'll be gone. You would have passed on, and that 100,000 is for your beneficiaries. So I think that's an area that, it's just basically education. You just have to understand how a policy works, and that 100,000 is life insurance, not a savings, and that's very important.
Thank you. That's amazing. Wow.
I love it. I love it because a lot of that is just people uninformed about the industry, and they hear, from a friend or a family member that kind of know, but they're not in the industry. And then you someone that's just trying to sell you a product and don't really dive into the education. So that's why we appreciate you for educating on that. And I want to talk a little bit about, the misconceptions, meaning that a lot of people say, I don't buy life insurance. And the reason why I don't buy, because they don't pay out. I kind of want you to give us, and a lot of times, because I know, like, I just love this field. So I want to make sure it's clear for the audience about when people lapse and not paying and lying on their policy. And the reason some insurance company don't pay out. So can you give us a little?
Sure. And now, by law, every insurance company has to pay a claim. That's the law, right? If it's a legitimate claim and you have been paying premiums, they are supposed to pay that claim. Now, that being said, let's just talk about what insurance companies actually do. So it really depends on the company, and you will find that sometimes insurance companies will actually come up with creative reasons not to pay a life claim. Maybe, like I said, if it's an accident, if they die by accident, however, they were in a hospital for a while and they actually had a heart attack, and the heart attack is what took them out, then they only pay the base amount. They don't pay the full amount because it wasn't an accident. So they may have $1 million accidental policy, but because they didn't die of the actual accident, they died for other reasons, heart just gave out, then they're only obligated to pay the minimum, and that may have been the $10,000, right? Other reasons are usually because maybe the individual did not disclose everything at the time of the policy. And that's a big issue in the insurance industry, is when the claim is not paid because maybe the person did not divulge all the information that they should have divulged upfront in the policy. And even if that policy is issued, they usually do, you have something called a contestability period, and that's the first 2 years of an insurance policy. So in the first 2 years, they have the right to investigate. And if they find that an individual was not upfront about the medical information and their illness, they may or may not pay that policy, right? And it's unfortunate. However, after the contestability period, which is after the 2 years, and this is every insurance policy, the insurance company has to pay the claim regardless, and usually have to pay it within 7 to 14 days, because after the contestability period, nothing is contestable and it has to be paid. But within the first 2 years, they have the right to ask, how did the person die? Did they know that they basically had cancer and or whatever that illness is that they pass away from, whether or not they knew about it? And they, especially when you say no, 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 and then only to find out later on that the illness was present even before the life insurance policy. So they have the right to ask. And usually what they do, if they don't if they do not pay the policy and pay the claim, they will usually reimburse the individual for the amount that they paid from the time that they got the policy. So that's about 2 years of premium, but they will not pay the policy, right? So wrong information on the policy. And, people always talk about, what if my policy lapses? Well, with term insurance, usually you have 30 days grace period to get your policy back in force if you're on what is called a automatic draft. They usually give you a little bit more time, and usually at that time you got to get your premiums in so that the policy can be good. With cash value life insurance, they usually take money from the cash value to pay the premium that is owed. However, if there's nothing in there, you can't get anything from zero, right? So
Right.
usually what happens is if there's no money in the cash value, then the policy will lapse anyway. So a lapsed policy is a lapsed policy. As long as you're paying your premiums and as long as you didn't misstate facts during your application, the company is obligated to pay that claim in the first 2 years. They have 90 days to contest it if there's any contesting. And after 90 days, after 2 years, they can't even contest it. And it's usually paid within a week to 2 week period of time.
Wow. And this topic, I could talk about this all day, and we have to have you on for a part 2 because there's so
Definitely.
many I haven't even dived into that we want to ask you. But
Right.
I'm going to conclude it today, but we thank you so much because this is so important that everybody in every family understands the difference to protect their family and to make sure they're financially stable. And we're going to get into that next time. But we want to thank you again for just educating us today and just going through the basics of life insurance. But we really want to have you back again and have you to go over some more questions if you don't mind. We would love.
I love it.
All right. Well, guys, with that being said, that concludes today's episode of Millennial Intent, Conversations That Matter. And Dame, do you have any closing words?
I am absolutely. We thank Miss Lillian Perry White for coming on and sharing her wealth of knowledge with us. I'm going to put her contact information in the description and also at the end of this video so that if you would like to reach out with her, she's an absolute straight shooter, helps with our our family's finances for years. The person we go to for these matters, a person that's been through the trenches. So it's all up to us to get our house in order before the good Lord, no matter who you believe in, takes you away. So with that being said, bye.
Bye.
To hear more from Millennial Intent, hit like and subscribe. And don't forget to tell a friend.